everyone, this is Mark Workmeister with PFA, and I'm here to give you another monthly update. We have talked a ton about tariffs lately with everything going on in the world, but we're going to kind of narrow in a little bit and still talk about tariffs, but really talk about specifically how it relates to the U.S.'s relationship with China, which seems to be driving most of this conversation. So currently, as it stands, the U.S. has about 145% tariff on Chinese goods that are being imported. In return, China has placed 125% tariff on U.S. goods that are being imported. So the numbers would show you that we're exporting about 144 billion to China. They are exporting 439 billion to us. So this has caused major issues in both countries so far, and it's not new. In President Trump's first term, we did place tariffs on China, though not to this level, and we've seen rocky markets in 2018. We also seen them rebound in 2019. Part of the difference this time around is we've seen very elevated U.S. stock market valuations going into this drop. And so when you have elevated stock prices and turmoil hit at the same time, you generally do see drops happen a little faster. The tech bubble in 2000 is an example. We started to see some turmoil, and we had companies that were already trading at very high multiples, so it's a lot harder, or easier I should say, for them to fall once that turmoil hits. The other side, looking at it from China's side, is they have some economic problems of their own. And this chart will show you, if you look at the US dollar index and the UN index over the last 24 months, you've seen both of those currencies actually get devalued. China has had a real estate bubble. They've had financial stimulus the past couple of years. They're looking at more financial stimulus. And so this really is currently, going to hurt both countries the way it stands. China has devalued their currency in part to help their exporters. So a way around the tariffs is to devalue your currency. That way the people importing your goods have to pay less because their dollar goes further. They can buy more goods with the same amount compared to your currency, which allows them to bring it in cheaper, and then by the time you add the tariff, the hit's not quite as good. But devaluing your currency, or the US dollar, we didn't devalue our currency, but it has dropped. Both of those carry financial risk locally as well within the country. The last point we're going to touch on real quick is just who holds US Treasuries. So we've seen some noise out there that China holds some leverage because they own so much of the US debt. And it is true, they own $0.8 trillion of US Treasuries, which is a lot. But compared to other countries, they're at 2.1% of the total. And most of the US Treasuries are still held domestically by US businesses, US residents, and other local entities within the US. So I hope this helps give you a little bit of information on the relationship the United States has with China. Long term, downturns like this, volatile markets like this is why we diversify. So if you have a good investment plan going into it, not only will you reduce your risk of any major portfolio drops within one asset class or one country, but you'll also open yourself up to some opportunities as we've seen over the long term. As always, if you have any questions or would like to discuss, please reach out to me. Thank you for watching.